Hi guys, welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita Khemka. Well, hasn't been a good Friday. In fact, hasn't been a good week for the market. So to say, given the fact that we've recorded the biggest weekly fall in over 2 years. Today, the Nifty cracked below the 23,600 mark as well. So major support levels broken on the downside. We've seen the Nifty correcting over 1,100 points Friday to Friday, and Sensex as well. Over 4,000 point cut coming in. Since last week. For the week, both the Nifty and Sensex are down almost 5%. And if you look at the broader end of the markets, they were kind of outperforming the benchmarks, and for the week they have outperformed the benchmarks. But today, both the mid and small cap indices tanked anywhere between 2 to 3% apiece. The worst part is that the Nifty Bank Index that had just started doing well, that has also succumbed to selling pressure. Recent times, we've seen the Nifty Bank Index also, witness consistent selling pressure. Today, it broke below that 51,000 mark as well. And the IT pack that was expected to do well in the wake of Accenture's revised guidance, but that also it did see initial gains, but succumbed to selling pressure around midday or so. Realty, IT, PSU banks, auto, all of these sectors saw cuts in excess of 2% apiece. All the sectors were trading in the red today. Just a few handful of gainers. But if you look at the technology names, TCS itself was down 6.5% for the week. Pharma, has been witnessing traction. So if you look at the likes of DRL, continues to see buying interest. That was the top Nifty gainer today as well, surging 9% in the last 3 sessions. Aside of that, if you look at some of the big losers today, you had the likes of Tech Mahindra, that was leading the pack in terms of losers. Trent, Mahindra and Mahindra, IndusInd Bank, Axis Bank were some of the other laggards. As I mentioned, gainers were few and far between. Dr. Reddy's topping the charts. HDFC Life was doing well. ICICI, bucking the trend when it comes to banks. Titan and Nestle, these were some of the other gainers. But of course, it's the biggest fall for the market since weekly fall rather, for the market since June of 2022. Except pharma, all sectoral indices have posted losses. The biggest sectoral laggards this week have been the likes of PSU Bank, the PSU basket as a whole, metals, these are some of the indices that have lost in excess of 6% for the week. Only 48 out of 50 Nifty stocks have given negative returns. Only two, I meant to say only 2 stocks this week have given positive returns, and they are both from the pharma pack, Dr. Reddy's as well as Cipla. And, majority of mid-cap names have seen selling, the likes of Angel One, Siemens, Adani Green, LTI Mindtree. These have been the top mid-cap losers. On that note, let's understand, how the setup is looking like, because, we are going into a Christmas week and there's no Christmas cheer. In fact, what we've seen is exacerbated selling. Each day of the week, we've seen the market sell off. Let me bring on board our guest for today. Joining me is Mayuresh Joshi, Head of Equity Research at William O'Neill, India. Mayuresh, string of bad news, and the latest one being the spoiler from the US Federal Reserve in terms of the number of rate cuts that we are looking at in the US next year. You look at the GDP data that has disappointed, although it's a cyclical downturn. If experts, if you listen to experts, and aside of that, you have a record trade deficit as well. So all in all, a somber mood going into the holiday week. Here on, what would you expect?
I think you rightly pointed out. I think the data points that have come out so far are pointing out that inflation might probably remain sticky, and therefore the rate cut cycle might get prolonged as per the Fed dot plot. Having said that, even the earnings season for India Inc. has relatively been soft in Q2. A large part of the expectations is that Q3 might be soft as well. You've already seen signs of urban consumption slowing down in certain pockets. Might get offset in terms of rural consumption coming back. But to a large extent, as private capex lags, and even if government capex does come through in the second half, it might not be enough for an earnings revival to happen. Probably in Q3 and probably in Q4. So I think the best case scenario now getting built in is the first half of the next financial year is when the earnings pickup will start happening. So till that point of time, I think the markets have to contend with earnings which are soft, and therefore the re-rating that the markets had given in the previous few quarters might not happen. at least for the next 2 quarters. So there might be a period of sluggishness, a period of consolidation for the markets. As far as the US markets are concerned, obviously how data points are playing out is going to be extremely critical. And as Trump assumes office, what does Trump 2.0 actually throw out? We've already seen hints and signs of some element of tariffs being imposed on a few nations, and that might get replicated for a whole host of countries which are taxing the US on a reciprocal basis. And therefore, I think tariffs, the corporate tax cuts of what one hears about might keep inflation a tad bit sticky. So I think there are a lot of points to probably comprehend with. And let's not forget, Nandita, that as we head into the new year, a month down the line, we'll have the budget. So the markets will also start racing in for the budget.
Right, of course, the budget will be, the next trigger, so to say, aside of the third quarter earning season, which is why I come to IT stocks now. They underperformed today despite Accenture's guidance revision, right? The read-through for Indian IT is that there's been no pickup in discretionary spending as such. The deal environment is also pretty soft. But there are positives also, right? Like the, growth in BFSI, the headcounts going up for a second straight quarter. AI bookings have also been good, but still, nothing really called for a sell-off that we've seen, when it comes to IT names today. If you've seen the likes of Tech Mahindra, that was the top laggard on the Nifty. But given the fact that we've already seen quite a bit of a run-up, especially in the mid-cap IT space, do you think this is just a valuation correction that's playing out, and all the good news in terms of whatever recovery is being expected is already baked into the prices?
To a large extent, I would completely agree. I think there is profit booking because I think this has been the best performing sector. And obviously, I think what the commentaries have been suggesting, Nandita, specifically for mid-cap IT companies, is that the revenue growth probably remains very, very strong. They are not seeing any pain points as far as pricing is concerned. And therefore, I think order wins, as they will get decided. Obviously, this quarter is where furlongs and Christmas holidays will play a large part. But Q4 in our context is where typically discretionary spending patterns get decided. The managements of a lot of companies are hopeful that the trend will probably not change. And therefore, I think the kind of expectation that one really has in terms of constant revenue or dollar revenue growth remains strong and stable. EBIT margin performance accounting for the increase in stability in costs that we've seen, specifically in subcontracting, and expectation that once Trump resumes office again, there will be some element of onshore hiring that will be required. That might just bump up costs, but the companies will be adept to that in my sense. And therefore, I think earnings, at least by management say, should remain strong along with margins, which should give some element of respite on the premium valuations that they're probably deriving. Having said that, obviously, if you have a valuation stack up done for mid-cap or large-cap IT companies compared to the 5-year standard deviations, the averages or the mean averages are way lower at this juncture. And therefore, I think any earnings mismatch, if it does take place, might result in some element of profit booking, which might take place in select IT companies. But having said that, my own sense is that a few of the mid-cap IT companies should continue doing well. We continue holding certain stocks which have performed well. In our opinion, I think looking at commentaries might continue doing so. Something like an emphasis, Coforge, Persistent, have done well. And the kind of technologies that they are developing, specifically in the fields of cloud computing and generative AI, is something that can cater to a lot of industries, BFSI, retail, manufacturing in North America and Europe.
What about the renewed selling in banks? Today, the Nifty Bank Index, broke below that 51,000 level as well. We had seen the banking pack, starting to outperform, and then there was this CRR cut as well by the RBI. But of course, HDFC Bank, ICICI Bank, they have come off, after the recent outperformance. Any particular trigger according to you?
So again, I think the moot cause is if rate cuts are slower and lower. I mean, if it doesn't happen at the pace that the market is expecting, there might not be significant balance sheet expansion. I think this is what the street probably believes. But my own sense is that rate cuts is one of the enablers for the system as a whole. If you probably look at how numbers have been playing out, I think the credit deposit growth has been pretty stable. Deposit growth for the first time has exceeded credit growth after a long, long time last month. And therefore, I think as numbers normalize, banks with a very strong liability franchise should obviously take in the benefits over the next few quarters. My own sense suggests that asset quality pressures are absolutely at low levels. Banks are selectively taking risks in terms of advances specifically to the corporate segment. Again, the RBI curves over the last few months in terms of unsecured lending step in the right direction because that does protect bank balance sheets. To that extent, provisioning for a whole host of banks, including private and public, is largely elevated. Annualized credit costs should remain constant and NIMs should remain stable at this level as well. So if rate cuts are slower as well, I think the entire ecosystem in terms of government capex, the expectations in terms of some element of legs of growth given to the private industries as well, corporate credit as well as retail credit as well. I think that should grow at a decent pace in the next few quarters. Valuations are very, very supportive. And therefore, ROAs should have decent stability and expansion as we head to the next year of second half of the next financial year. So again, the mood sense that I'm getting is that because rate cuts might be slower or at a lesser pace, I think the sell-off has probably happened. But I think that should not be a reason for the banks to correct. I think we remain optimistic because the overall balance sheet growth and valuations continue to be supportive for BFSI as well.
Right. One stock I want to speak to you regarding was Siemens. It has taken a sharp knock today after the management said in its conference call that overall private capex has not picked up meaningfully. But it did point out that private capex in semiconductors, batteries, and solar PVs and the electric vehicle space has been good. Of course, these comments also, had a rub-off impact on shares of ABB India. Both the stocks have, although seen a very good, bump up. If you look at the YTD returns, especially for Siemens, that's up over 70%, right? So, after these comments, how are you viewing this particular stock?
So I think, Nandita, I think after the commentary, the street probably is of the opinion that orders might not come their way because they believe that they are strong in VSC technology, which supposedly is their forte. But again, I think orders will come through, in my opinion, and it's not just Siemens for the entire ecosystem as a whole. And orders will come to at a decent margin. So I think the street probably believes post the commentary that orders might probably just stall, which might not be the case in my opinion. I think the street is reading a little bit too much. Orders will come through with good margins and they will be able to execute it well. So I think selectively this space will do well. Obviously, Q3 might be a little bit soft as well because they're just coming out of the first half where tendering, ordering has probably not been at its best because of various factors, including elections, monsoon, so on and so forth. As the government capex resumes, I think the orders should start coming back. And in my own sense, I think the 11.1 lakh crore budgetary allocation on capital account that was there last year should see significant improvement as we head into the next year as well. The private capex is definitely lagging. There is no two ways about it. But at some point of time, it should start coming back as government capex might support the overall economic growth, providing stimulus for private capex to come in. So, I mean, I'm not overly perturbed. I think the street, in my opinion, is reading a little bit too much in terms of the commentary.
Right, and we did see a knee-jerk reaction in shares of Siemens, right? It was down somewhere around 8.5% or so. Just a couple of more questions. City gas distribution companies, I think we had a off-the-record chat about it as well. But the stocks have recovered, quite significantly from November lows, after the twin deallocation of APM gas. And the companies also, took some price hikes, although they were much lower than what they really need to make up for increased costs. But given the fact that gas coming under GST was maybe one of the triggers, which is why the stock saw some bit of a rebound. But now that sources are saying that that issue is off the agenda for GST meet tomorrow, how would you view this entire basket? I think last time we spoke, you said that this is perhaps not the time to look at this particular basket in terms of investment. But anything has changed after the price hikes that they've taken, or subsequent price hikes that they may take going forward?
So it's a catch-22 situation, right, Nandita? Because if they have not taken sufficient price hikes, that means that their EBITDA and their absolute EBITDA and EBITDA margins will obviously take a hit. Now, as the EBITDA per SEM takes a knock, obviously forward-looking earnings, if the policy does not change, remains circumspect in terms of future earnings growth. At the same time, if they take a substantial price hike, there is every possibility that there might be some element of clamp down that you're probably seeing in overall volumes. as other competitive fuels might actually start performing better compared to what these city gas distribution companies are doing. Having said that, I think the spaces that they run out of, specifically PNG, I think that should do well. CNG again should normalize at some point of time. And as things normalize, because what we've been probably hearing is that as more and more supply starts coming through, there is a huge probability that some point in the next financial year, you might see the reversal of this probably happening. Yeah. Till that point of time, there are a lot of ifs and buts that are associated with all these stocks under consideration. And therefore, I think the better mode will still be wait and watch. Q3 numbers will still be soft, and it is to be seen how markets will react.
So, last question really, Mayuresh. It's time to recalibrate portfolios for the new year, right? And, given the kind of correction that we've seen in the market, one may argue that, the entry point or prices may be looking attractive for some of the pockets. Anything that you could identify, as one recalibrates their portfolio for the new year?
So I think a few agrochemical stocks might do well because numbers have ended up pretty strongly for them in Q2. So I think the performance might continue because you've probably seen good reservoir levels. Rabi harvest has been pretty strong. And therefore, I think there is a strong indication that numbers might continue remaining strong for the remaining of the year for a large part of the space. BFSS selectively, as I said, looks attractively placed, both from a valuation as well as our markets with ideology perspective, EPS, RS ratings, institutional holding as we've seen in Caslin. Selective infrastructure manufacturing names might continue doing well, including subsects like cement selectively, where pricing, where consolidation, where expectation of absolute EBITDA growth might be on the anvil for these companies. And within the broader markets, I think a few pockets might continue doing well. So a few stocks that we like within the broader market without classifying them into certain pockets. Praj Industries, as an example, has huge runaway growth in front of it over the next few years. Leadership position in the areas that they operate out of, or something like an Apple India is something that we like at Markets with India. Again, leadership position in mobile communications that it probably possesses, and strong earnings trajectory that is has done in the past, continuing so far and expected to continue. So I think where earnings will continue to grow, the markets might still give a little bit of premium to the stocks, even if valuations might remain a tad bit on the flat side.
All right. On that note, it's time to say goodbye, Mayuresh. I know the mood is pretty somber in the market, but I hope you have a good holiday season nevertheless. So in case we don't meet up this year, wish you a very Merry Christmas, a Happy New Year, and a very prosperous year ahead in terms of investments as well.
Thank you so much, Nandita. I think if we don't catch up, Merry Christmas to you, Happy New Year to you, to all your viewers, and hope that the new year is full of good health, wealth, peace, and prosperity.
Same to you, Mayuresh. Thanks a lot. Well, with that, of course, we've come to the end of this edition of Closing Bell. A somber close to the week as we head into a holiday week. Biggest weekly fall for the market in over 2 years. Things not looking all that great, but who knows? The bulls, may try to fight back a bit, and who knows? Santa may appear or make an appearance sometime next week. But on that note, thanks a lot for tuning in to Closing Bell. It's a goodbye from me and the entire team. Stay tuned to Money Control for all your other news and updates, and have a happy weekend.